just welcome you to our webinar today. So thank you for joining. And today's webinar is going to be about the LGPS actuarial valuation. This is going to be a lot more fun than going out doing your festive shopping. So hopefully you're all warm and cozy and ready for a couple of hours of let's call it pensions entertainment. But seriously, thank you for joining us for what will hopefully be a really useful session. And over the next couple of hours, we're going to cover things like why the actuarial valuation happens and how it's carried out. We'll hear about the key outcomes and what do funding positions mean. We're going to then talk about how those funding positions and those outcomes drive the setting of employee contribution rates, the role of the funding strategy statement, and the next steps and some timelines. And we're also going to give you an update on progress for some active and emerging LGPS developments as well. So hopefully by lunchtime, the valuation will all be crystal clear with everyone, and you'll be able to plan for your employee contributions for the next 3 years. But before we start, I'm just going to run through very quickly a few housekeeping protocols for the meeting. I bet most of you are familiar now with how webinars work, but I'll just run through a few things. So start time and end time, well, we've started. The end time we're going to aim to be completed by 12 at the latest. We'll probably be able to finish a little bit earlier, but we should be done by 12 o'clock. Cameras and microphones. So we've switched everybody's cameras and microphones off to help with the bandwidth as there's we're anticipating a lot of people on the session today. If anybody has a question, please post it within the Q&A section. Hopefully on everybody's screen you can do this through the Q&A button, which is at the top of your window. We'll have some time following each presentation to pick up any questions that have been added to the Q&A panel. And if we do run out of time, we'll take any outstanding questions away to reply to over the next few days. Live captions. If anybody wants live captions on your screen, in Teams, you press the 3 dots which are at the top of the window, the ones that say More underneath. Then go to language and speech and then show live captions. And if you want to switch off the live captions, then it's the same route, but the button will say hide live captions. So that's if anybody wants to use the live captions. The session is going to be recorded or is being recorded now and will be available on the Fund's website and the Fund's YouTube channel later. So if you've got any colleagues that couldn't make today's event, it will be available for them to watch later. After the meeting, we're going to issue or we're going to send a link to a feedback form so you can let us know how helpful the meeting's been. Should only take a few minutes to complete and be really helpful to us. So be very grateful if you could find a minute or so after the meeting to submit your feedback. So look out for that email when that feedback form gets sent around. And we'll also send out copies of the slides. So please don't worry about having to take lengthy notes as we go through, as you'll have the slides hopefully very soon. So let's get started. I'm just going to run through the morning's agenda. We're going to begin with a presentation by the Pension Fund's actuary, Barry Dodds from Hymans Robertson. I'll then summarise the next steps in the valuation process, and we'll have a short 5-minute break at that point. And then in the second half, our Head of Pension Fund, Dawn Kinley, will provide an update on the LGPS Fit for the Future proposals, which gained a lot of headlines, probably around about this time last year, when the Chancellor opened the debate about the future of the LGPS in her Mansion House speech. Things have moved on quite a lot since then, so Dawn will get us up to speed with what's happened so far. Then finally, Vincent Kinder, who leads our employee relations team, and many of you probably already know, will deliver a short update on other matters that are developing in the LGPS at the moment. So let's start with headliner, and probably the reason why you're all here. So our fund actuary, Barry, is going to talk you through the valuation exercise, why it happens, how it happens, and what it means. Just before we hand over to Barry, though, I'm just going to explain very briefly that we have begun issuing valuation result schedules over the last few days, and many of you hopefully have already received yours. Barry and his colleagues are working through the remainder at the moment, which we'll be issuing to employees as soon as they're ready. The vast majority of those hopefully by the end of next week. So whether or not you have your schedule yet, I think you'll find Barry's explanation really helpful. So over to you, Barry.
Thank you very much, Steve. I'll just try and start sharing my slides. Not sure I'll live up to the build up, to be honest, Steve, of making it really entertaining, but I'll see what I can do. So hi everybody, I am Barry Dodds. As Steve mentioned, I am one of the actuaries at Hymans Robertson, who is the fund's fund actuary. So I've worked with Steve and Don and all the other officers for about the last kind of 8 years or so on the fund. So I've got a lot of background knowledge on the fund. And yeah, so I am going to take you through a bit of background information, which should hopefully give you some useful knowledge while you're looking at your results and looking at the funding strategy statement over the coming weeks. So looks like quite a long agenda here. Hopefully I'll be about 40 minutes, something like that, and then leave plenty of time for some questions at the end. So going to start off with a bit of background to actuarial valuations. Going to then kind of move on to what the results are looking like at whole fund level. Obviously, you all as employers make up your own part of the fund. But what we do first of all is we look at the whole fund position, see what that's looking like, and then we delve into each individual employer's position to work out an appropriate contribution rate to be paid over the next 3 years, which I will touch on as well in section 3. We've got a kind of dummy results schedule in the slides, which I'll talk you through just to point out what the different sections of your results schedule are, to give you a bit more info there. And then I'll talk a little bit about the funding strategy statement, which is a document which is out for consultation with all the employers just now. And it would be really good to get feedback from you all on that. And then basically a kind of what is the fund's ask of you over the coming weeks. So start with a bit of background. Why do we actually do a valuation? Well, we have to under the legislation. So that's a very good reason number one to do it. We do one every 3 years in line with the regulations. It's also very useful to actually look at what the actual experience of the fund has been against what we assumed at the previous valuation. So it's a good time to do that. And it's generally a kind of health check on how solvent is the fund, how do the assets that are held compare to the value that we expect needed to cover the benefits that are to be paid out. It's also a requirement to review the funding strategy statement and the funding strategy itself at employer level every 3 years. So useful to do that as well. But arguably this last point is the main event, and the main reason that we do evaluation is to work out appropriate employer contribution rates for the coming 3 years. So ultimately the valuation is a kind of risk management exercise. And it's quite a large exercise that takes kind of more than a year to do. We do start work on the valuation long before the valuation date actually comes along, and then we have a year from that date to actually finalize the valuation. So what are the basics of the fund and how the fund works? So the fund collects money in from you as employers and from the employees that you employ. they pay contributions as well. That money gets invested, and so there's a whole different element that fund officers deal with in terms of the investment of those assets and appropriate asset classes to invest in. But ultimately, the whole point is that this money is intended to be enough to pay out the benefits, pay out the pensions to members when they fall due. So how does this kind of balance? How do we balance the two sides of the equation here in terms of money coming in from the employee contributions and employer contributions, plus investment returns that you hope to obtain on those contributions? How do we make sure that that's enough to cover the benefits? Well, on this slide, you'll see there's some padlocked items, which the benefits themselves are specified in the regulations and in legislation, so they are kind of fixed, if you like. We know what they are going to be or how they're going to be calculated for any individual. The other padlock there is next to employee contributions. So again, employee contribution levels vary. They vary by salary, but those different contribution levels are again specified in the regulations and in legislation. So you can't, as a fund, change those either. Now there's a wee question mark next to investment returns. Obviously, investment returns are not known. We don't know what money is going to be earned on your investments in the future. So that's a bit of an unknown. And we've got a kind of set of tools next to the employer contributions, because ultimately the employer contributions are the kind of balancing item. That's the main tool that the fund can use to make sure there's enough money in the pot, if you like, to pay the benefits at the end of the day. So that brings me on to the kind of one of the key funding decisions. So this chart on the left kind of illustrates the various different elements that we look at a valuation. So on the left-hand side, the green bars are what we call the liabilities, or in other words, the value that we place on the benefits that have been earned by members, either up to date, up to now, which is the kind of dark green box at the bottom is the benefits earned up until now. And then the light green box is the benefits that we expect to be earned in the future by members. Now you'll notice that the light green box is quite a bit bigger than the dark green box, and you might think, well, the liabilities of the fund are very big. They're in the billions of pounds, and that's the ones that have already been earned. But actually, given that it's an open fund, an open scheme, the benefits that are going to be earned in the future will actually kind of be much bigger than what's already been earned to date. On the right hand side, the assets, we've got again a kind of assets today figure, the box, dark blue box on the right. And as you can see, that dark blue box is a bit bigger than the benefits earned to date box, and that's basically indicating that at the moment the fund as a whole has a bit of a surplus, a reported surplus. So that's a good position to be in. But really, one of the key factors and the vast majority of what your contributions are paid towards is actually the future benefits that are being accrued. So that's a key focus of the valuation, is how much does the fund rely on future contributions coming in, and how much does it rely on future investment returns on the assets that we already have and on the contributions that come in. So where that kind of pink line is drawn is a key decision at each valuation in terms of how much prudence, if you like, we apply, how much are we relying on investment returns, which are unknown, and how much are we relying on future contributions. It's important to point out that the darker coloured boxes, so the assets today box and the benefits earned to date box, that is what we call past service figures, and that's how we derive the funding level. So the assets today box divided by the benefits earned to date is how we come up with a funding level. And and that is only based on past service. It ignores any future benefits that are going to be earned. So how do we actually do evaluation in practice? This slide kind of sets it out as simply as we could try to do. There are many inputs that we use. So we use data for every single member in the fund, and there's tens of thousands of members in the fund, so that's a lot of data. We have to make financial and demographic assumptions. So I'll come on to a little bit more detail about what some of those assumptions are shortly, but we have to make an awful lot of assumptions about what might happen in the future when we do a valuation to try and place a liability value now on all these benefits that might be paid out decades into the future. We have to think about the funding strategy, but also the investment strategy. Obviously, how much money we need now very much depends on how much money we expect to earn on the investments that the fund has. So we have to make sure that we're consistent when we're looking at the funding side of things at the valuation. And then there's the LGPS benefit structure, which is very important. It's kind of added to almost as an afterthought at the bottom there, but obviously we use the LGPS benefit structure to try and project what benefits are going to be paid to each member in the future. So we feed all that information into our models in the middle there, and then the main outputs that we get are obviously the individual employer results schedules, which some of you will have received and the rest of you will receive shortly. So that sets out the results for you at an individual employer level and what the contribution rates payable will be over the next 3 years. But we also produce an updated funding strategy statement. So that is a document, again, I'll come into a bit more detail later on, but that is essentially the kind of the fund's rule book of how it deals with employers in the fund from start to finish. And then in March, we will produce a final valuation report, which just kind of documents all the valuation results at that point in time, and also has what's called a rates and adjustments certificate at the end of it, which sets out the contribution rates payable by every employer in the fund. So this is just a kind of brief headline items of what's been done to date as part of the valuation, and then what's still to go. As you can see, we're kind of towards the end of the timeline, which is good, and we've done an awful lot of work with officers up until now to get to this stage. So what's still to come is basically employer discussions, and I'll come to that later on in terms of the officers are very keen to hear feedback from you, not just about your own results, but also about the funding strategy statement itself. And then, so that'll be kind of round about probably post-Christmas, those discussions, and then everything gets signed off in March. So what do the results look like this time around? So this is at whole fund level. This is the position. So at the last valuation, you'll see that the blue bar, which is the assets, pretty much exactly the same as the green bar. So pretty much exactly 100% funded. There was a slight, very small. I always laugh when I say very small, and I'm talking about millions of pounds, but a small £1 million surplus at the last valuation. This valuation, as you can see, the blue bar is quite a bit bigger than the green bar, so we are reporting a good surplus position at this valuation. Now, you'll see the blue bar has grown since the last valuation, so the assets are higher now than they were at the last valuation. However, the asset returns have actually been slightly lower than we assumed at the last valuation, and I'll come on to this in a bit more detail shortly. But it's just one thing to bear in mind, that the results here in terms of the funding level improvement are not because the asset returns have been shooting it out of the park. It's actually more to do with the difference in the green bars that we're seeing here. So what are the green bars? The green bars are the value we place on the liabilities. So the value now of all the decades of pension outgo that we expect to be paid out of the fund over the coming years. Now, the reason that has dropped quite a bit, the green bar from the last valuation to this valuation, is actually because we are, the markets kind of now, compared to 3 years ago, are expecting future investment returns to be higher than they were 3 years ago. Now, the primary reason behind that is rising interest rates. So 3 years ago, you may remember interest rates on your bank account were probably about 0.5%, 1/4%, 0.75%, something like that. Whereas now they're up around kind of 4.5%. Now the fund doesn't just invest, doesn't put all its money in bank accounts. It puts its money in various different assets, and what you would see is not necessarily a direct correlation between interest rates and expected returns on those other asset classes the fund invests in, but generally speaking, if you can now get 4% per annum more in your bank account, on your bank account savings, you would expect to see a kind of corresponding increase in your other investment returns and other assets that you can achieve. So by assuming we are going to get higher investment returns in the future, we need less money now to cover the benefits, which is why that liability value has dropped, because ultimately we're saying, well, actually, we think we're going to get more money from our investments over the coming years, so we don't need as much money now to cover those benefits. So that's the primary reason behind the funding level change, rather than actual investment returns that have been achieved to date. I should point out that that's at whole fund level, that funding level change. Your individual funding position is unique to you as an employer and your members, and so it will differ from that. Some will not see the same kind of level of increase in funding level. It very much depends what has happened to your members over the last 3 years. So to go into the kind of the change in the funding level in a bit more detail, this is a kind of waterfall chart, if you like, showing on the left-hand side the position at the last valuation, so that very small surplus, and then showing the various elements of what has happened to make it go from last time's number to this time's number. Now we start off by showing the kind of the known events, if you like. So this is things like what actual benefit increases have there been over the last 3 years compared to what we assumed. And in particular, that item is the biggest pink box that you see there, showing a particularly negative impact on your funding level because inflation's been very high over the last 3 years. And so the impact of that on the benefits being paid has been that they've all gone up quite a lot. And that's had a negative impact on your funding level because it's pushed that liability value up. So in this chart, the pink boxes are elements where it has been not good for your funding level, in the sense that it's kind of it's increased the deficit. And any green boxes you see, which you don't really see any of, I think there's one very small one there, they are being beneficial to the funding position, so kind of reducing the deficit or increasing the surplus. So as you can see, pretty much all of the known events are pink boxes, which is not good for your funding level. So all the known events over the last 3 years would have actually led to a deficit position in the fund at this valuation of around about 900 million. So if we'd only taken into account what's actually happened over the last 3 years, known events, you would actually have a £900 million deficit in the fund. However, the reason that we're actually showing a surplus is because of what we call future expectations. So as I mentioned earlier, the future expected return on the assets that the fund holds is considerably higher now as a result of those interest rate changes, and so that places a lower value on the liabilities and therefore improves your funding level. And that's that big green box there. So as you can see, that's having a very big impact on the funding level, essentially creating a fairly big surplus there just based on that one assumption alone. Now, there is quite a lot of uncertainty in markets out there. There's a lot of uncertainty in the world at the moment. And as part of kind of consideration of that, the fund has decided to slightly increase its prudence margin this time around, which is that pink box on the far right there. So that's actually kind of taking a bit of an edge off the improved funding level position, just as a bit of a marker of, well, we're wanting to be a bit more cautious and say, well, let's not take fully into consideration all of this improved investment outlook. Let's just take a little bit off for a bit of caution due to the uncertainty in markets. So probably heading towards more what you're interested in, individual employer funding positions in the fund. Now, what you can see in the chart on the right hand side here, the pink line across the middle is the whole fund funding level, and all the dots that you see there are the various different employers funding levels in the fund. So as you can see, quite a lot of variation in funding level depending on what employer it is that we're looking at, and that's for very good reasons, in the sense that every employer has its own kind of funding profile, has its own group of members, and they can vary quite a lot in terms of the profile of the members. So membership experience has a big impact. So if some members go off on ill health retirement, that can have an impact on your funding level. Salary increases have an impact on your funding level, and obviously various different employers will experience this in different ways for their membership. Membership profile of you as an employer can be quite different from another employer. So you've got kind of age profile, gender profile, are two specific ones which can make a big difference. And indeed, the contributions that have been paid in over the last 3 years can have a big impact on how your funding level has moved. Obviously, the more contributions you pay in, the better your funding level will look in comparison to another employer. So as you can see, quite a range of funding levels across all the employers. And what we do to recognise this is that each individual kind of employer group we look at and say, okay, what's an appropriate funding strategy for that group of employers? So how do we actually set the contribution rates themselves? Obviously, this time around, we're seeing healthier funding positions, which is good. But we have also, we do also acknowledge that funding levels themselves just have limitations. They only reflect past service, so they ignore future service and whatever cost of that might be. And they're also based on one single set of assumptions. We have to come up with a funding level. We have to say, well, what's the value of the liabilities on one set of assumptions? So that's also a kind of limiting factor. It assumes one view of what the future might look like, one scenario. So really what we think about each valuation is the long-term strategy. That's the most important thing, particularly for longer term employers that are going to be in the fund for a good few years. We are seeing this time around that contribution relief is going to be possible for many employers. I would say the majority of the employers will see reductions in their contribution rates. However, we are being fairly cautious, and the officers are being cautious in terms of the level of those reductions, just to be aware and conscious of the uncertainty in markets and the uncertainty in the world at the moment, that we don't want to end up in the situation where we're making big reductions to contribution rates, only to in 3 years' time have to reverse that, and that might not be particularly palatable for you as employers if in 3 years' time we're racking up the rates again. So we're being cautious in terms of the approach there. Funding strategy, you've got 4 kind of boxes there around what we really consider as part of funding strategy. So long-term solvency, make sure we've got enough money. Long-term cost efficiency, so that's kind of goes hand in hand with the next box of stability. Want to make sure that we're not just chopping and changing rates up and down at every valuation. And we need to reflect employer characteristics, which is why we look at different employer groups in different ways. So we have 3 steps to setting a funding strategy. We have for every employer, we have a funding target. So that's kind of what are they aiming for, kind of at the end of their time horizon, which is the next item. Every employer has its own time horizon. For the long-term employers like councils and academies and so on, that is quite a long time horizon, and so we tend to use kind of 18 years as time horizon for those employers. But there are employers in the fund that are much shorter term than that. There are contractors, kind of cleaning contractors, catering contractors, who may only be in the fund for kind of 3 years, 5 years. So we have to bear that in mind and make sure we acknowledge that in their funding strategies to make sure that we're saying, right, okay, we appreciate you might only be in for 3 years, so there might be a different approach required for your contribution rates than a longer term employer. And then there's what we call likelihood of success, kind of how strong is this employer's covenant, and how sure do we need to be that they are going to be 100% funded at the end of the time horizon we're looking at. So we do this across all the employers to make sure that the appropriate circumstances for each employer are allowed for. Now this chart shows, it doesn't quite show 5,000 lines, but when we do the modelling, we model each individual employer on 5,000 different economic scenarios of what might happen over the time horizon that they're expected to be in the fund. And what we do is we work out a contribution rate where enough of those 5,000 scenarios are above 100% funded at the end, to make sure we're comfortable that that's an appropriate contribution rate for that employer. So it's a different way of doing things from the funding level, which you have to use just one set of assumptions. So ultimately, kind of one of these lines might correspond to that funding level approach. But for contribution rates, it's a much more suitable approach to say, right, okay, we appreciate there isn't one single answer here of what the future is going to look like. So we do 5,000 different scenarios, and we try and make sure enough of those are successful, if you like, at the end of the period. So this table essentially kind of summarizes one of the tables in the funding strategy statement, but kind of sets out those different funding parameters for the different groups of employers. Now, as you can see, for the top 4, they are largely treated the same. So councils, academies, colleges and town and parish councils are all seen as long-term secure employers in the fund. So they have a kind of 100% ongoing basis, as we describe it, funding target over an 18-year period. The likelihood of success that we're looking to achieve for those contributions is 80% for those employers, which matches the updated prudence level that the officers have decided on at this valuation. And all 4 of those employer groups have stabilised contributions, which I'll come to in a little bit more detail shortly in terms of what that is. For some of the other employer groups, there are slightly different approaches used in terms of funding parameters. So funding targets are all targeting 100% funding. There is one, the charities that don't have a guarantor, who actually have a different basis, a more prudent funding target basis called the low risk basis that we use. but the others are all 100% funding on an ongoing basis. They vary by time horizon, as I mentioned, kind of contractors and some charities as well that don't have a guarantor tend to have a shorter time horizon. And the likelihood of success varies as well, depending on largely depending on the kind of the view of the covenant of the different groups of employers there. So that, as I say, is detailed in a table in the funding strategy statement, which is out for consultation just now as well, but that's just a kind of brief summary of it there. I mentioned stabilisation, so the 4 groups that I mentioned that are kind of seen as long-term secure employers in the fund operate what's called the stabilisation mechanism. Now, the chart on the right here kind of demonstrates probably better than the words on the left what this is all about. The idea is that if you didn't have stabilisation in place, then at every valuation, your contribution rate could jump about like the blue lines on this chart. So it could be kind of up in the 20s, and then kind of the next valuation drop down a few percent. Next valuation could drop down a big amount and then bounce back up again at the following valuation. Now, the idea behind stabilisation for these long-term secure employers is that it kind of smooths out these ups and downs. And we can do that for the long-term secure employers because we know they're going to be there for a long time. So you've got that period to smooth out the rates. So that's kind of an indication of what the green line is doing here. It's just notching up a little bit every year when it needs to, and then kind of dropping down bit by bit when it could do. So it's smoothing out the ups and downs and the volatility of those blue lines. So on to what your actual valuation schedule looks like. Now, this is just a dummy schedule that we're going through here. I'll go through fairly swiftly. But this is kind of what each of your schedules will look like. So the front page has kind of some of the headline numbers in terms of funding level and surplus or deficit, and some kind of background wording. For some of you where your contribution rates are kind of the same over the 3 years, it'll also show your contribution rate on the front there. But page 2 has a bit more detail on your contribution rates. So it has this table at the top, which shows your current rate in payment as the top row, and then shows what will be payable over the coming 3 years in the 3 rows below that. And then there's a bit more explanation underneath about how they've been arrived at, and indeed kind of a bit further detail about how much on average your employees contribute as well. On the next page, there's a bit more background about the kind of funding parameters that I mentioned earlier, about kind of whether it's the ongoing basis, what the likelihood of success is, what the time horizon is, and things like that for you as an employer, just as a bit of background. And then the page after that has your funding position. So it will show last time's valuation funding position and this time's funding position. And then page after that shows a kind of breakdown, almost like it's basically a kind of tabular version of that waterfall chart that I showed you earlier that was at whole fund level. You as an individual employer will get a similar table to this, showing how your assets have moved over the last 3 years and how the liabilities have changed over that period too. There's also an appendix in your schedule which has data, so kind of membership data summary in it. So it will show last valuation and again this valuation. Now it's probably worthwhile you having a look at that, especially at this valuation's numbers. Make sure it kind of tallies with your expectations, just to make sure the data we're using for you as an employer is correct. There's also another appendix which has the assumptions that have been used last time and this time. So there's, as I mentioned before, financial assumptions and what we call demographic assumptions. The financial assumptions are predominantly around what we expect future investment returns to be, but also what we expect future inflation to be, because that's quite important as well. In terms of the demographic assumptions, the most important one there is around life expectancy, and we do give you a table in your schedule which kind of gives an indication of the life expectancy that we're using for your employees. So, funding strategy statement. I think this is the final bit that I'll be covering before we take questions. Funding strategy statement review is carried out every 3 years, as I mentioned at the beginning. It's a publicly available document. It is the fund's own document, and that is on the fund's website. The current draft is on there that you can access just now as part of the consultation. What we've done this time around is we have updated it for new guidance from the Scheme Advisory Board and MHCLG and SIPFA. So we've updated it for that, and then obviously we've updated it based on the approach that the fund is taking for the 2025 actuarial valuation as well. As mentioned, it's out for consultation, so do please feed back to officers any comments you have. There is one of the other main policies, which is also available on the fund's website, is the admissions, cessations and bulk transfer policy. It's all in one document, so do be aware that that also exists, and you can have a look at that on the fund's website. So what's the kind of ask of you from this? So do read through your results schedule. I'm sure that's probably the main thing that you've been waiting for. So do have a good read through it, check the data is correct in it, understand your funding position and the rate that's going to come into payment. Do have a look at the funding strategy statement. It can be a kind of a tough read. It's about 30 odd pages long, but it is quite an important document, and it does kind of set out how you are treated as an employer in the fund. So do please have a read through and feedback any comments to fund officers, and just in general kind of talk to the fund, ask officers any questions you have. If necessary, the officers will come to me if required to help with any answers, but do go to the officers in the first instance to ask any questions that you have. So that was all I was going to kind of take you through, but yeah, do you have any questions at this point? Sorry, I've not been looking at all at the Q&A.
Oh, it's okay. Thanks, Barry. That's really, really helpful. It is a really complicated subject, especially when you kind of don't touch it for a long time. You know, I feel for the employees who probably touch this every 3 years and come into it, and I think that really throws a bit of light on, like I say, is a really complicated subject. And unsurprisingly, we do have questions, Barry. So if you're able to, shall I go through them?
Yes, absolutely.
Okay, that's fine. So the first one is, can you confirm if ill health retirements are funded by the pension fund, or are the individual schools or trusts or employers liable for the additional strain cost?
Yes, ultimately it's the latter of those. So the individual employers are liable for any ill health strains. There is insurance available. If you contact officers, they can put you in touch with the relevant people if you're interested in getting insurance against that risk. It can be quite substantial, an ill health strain, depending on the individual circumstances of the member concerned, particularly if it's a kind of what they call a tier 1 ill health case, where the relevant person would actually get essentially a kind of uplift to their benefits, assuming they'd had service right up until the retirement age. So it can be quite a big strain, but yes, it is ultimately has to be funded by the employer rather than the fund.
Yeah. But just to add to that, Barry, there is a page on the website about the insurance. So if any employers are interested in having a look at that, have a look at the website first, and there's some information on there as to how you can get some more details about it. In terms of our own policy in the fund, for an ill health retirement, just to confirm, we don't actually issue an invoice for any pension strain. It's actually rolled up and considered at the next valuation. So when Barry's crunching in his numbers at the next valuation, that will become part of the considerations at that point. That's the position, isn't it, Barry? Is that okay?
Yes. So you might notice if you've had an ill health event since the last valuation, you might notice an impact on your funding level this time around. It could have a particularly negative impact on your funding level, which then will feed into whatever contribution requirements there are from you.
Yeah. Next question. As most employers will be budget setting at the moment, and these results are draft, is there any chance individual fund rates will change before a final version is issued in March?
They would only change if there is some reason brought forward by you as an employer to officers for that to happen. So we wouldn't anticipate these rates changing. I appreciate they are issued as draft, but we wouldn't anticipate them changing unless there's kind of further discussions between officers and yourselves to change those rates.
Yeah. And just to confirm, we if there is no change, we don't actually issue a further schedule in March. We do issue a revised form CR1, the contribution reporting form to you, which will show your new rate, and that will be coming out to you before the end of March. But you won't get a further schedule which says that this is the confirmed version. On to the next question. Can you please explain the difference between primary and secondary contributions?
Yes, so primary and secondary rates are essentially something we have to split your total contribution rate into under the regulations, but broadly speaking, so the primary rate is essentially that cost of future benefit accrual. So that's how much we think you need to pay in to cover the benefits that are accruing in the coming year, essentially. The secondary rate is ultimately a kind of a balancing item to get you to whatever total rate we think you need to be payable. So more often than not, if you have, for example, a deficit, you'll probably have a positive secondary rate to try and bridge that gap between where you are and 100% funding. If you have a kind of healthy surplus, then there's a chance you might have a negative secondary rate. So ultimately you're kind of getting a bit of a discount on your future service rate because you've got a bit of a surplus, you've got a kind of chunky surplus there that can be used to kind of bring you back down ultimately towards 100% funding. So that's what tends to happen. That's not to say often you might even see if you are somewhere, say, between 100 and 110% funded, so you might have a slight surplus, you may still have a positive secondary rate, and that's predominantly due to the fact that funding level is kind of now, and when we look at the contribution rates, we say, right, okay, what might it look like at the end of your time horizon? So it's not necessarily just because you have a surplus now doesn't mean we expect you to have one at the end of your time horizon. So you may still have a small positive secondary even if you have a small surplus.
Just kind of in the same vein, this question says, could you please confirm what pay is used to calculate the secondary contributions? Is it the same as we use for the primary rate?
Yeah, so we use the payroll of your active members in terms of how much we expect to come in. I think in previous valuations, the secondary rate may sometimes have been expressed as a monetary amount, and that was largely where you had where we had deficits, and we were trying to make sure we got enough money in even if members left. So if you expect it as a percentage of pay, then you might not get as much money in as you expected if people left. So in previous valuations, you may have had a monetary secondary amount. This valuation, I think we're expressing them all as a percentage of pay because we're in a position where most of the employers are in surplus, and therefore we don't have that same concern about kind of making up that gap with monetary amounts.
Thank you. I think the next one, I think I can answer this one because it's a bit of a logistical one. And it's a question from a foundation school who say they are part of their local authority or council as the employer. Will you be able to send me a copy of their valuation results schedule so I can adjust our contributions rate for future budgets? So I know that there are some schools out there who we have as separate employers in the fund for recording purposes, but they are actually all part of their local council as the employer. For any schools that are like that, we are actually going to be writing out to you separately to tell you what your local council's position is. So you will get that information in writing from us. And I think we've got one more question, Barry. It's oh no, we've got one more. Does the employer contribution rate have any effect on the members' pension?
No, the members' pension is set out in stone. Ultimately, we use the employer's rate as a kind of tool to try and make sure there's enough money there. But ultimately, the members' pension is kind of set out in the regulations, and however much you pay is really just to make sure we've got enough money. It doesn't directly impact the members' pension.
Well, thank you for that. So they're all the questions we've had so far. If you've still got any more questions, then please pop them in the Q&A. If you can over the next few minutes. I know that definitely Barry's going to be staying with us just certainly for a few minutes longer while I just go over the next steps on the valuation process. So if you've got any more questions, please pop them in the Q&A section there, and we'll pick them up after I've just gone through the next steps. So if it's okay, I'll just do that now, and then in a moment we'll have a 5-minute break before we go on to the second half. So on the valuation, you've got your results schedule, or you'll have it very soon if you've not had it yet. But what happens next? So I'm just going to briefly run through the next steps. This first slide just lists the steps to be met in the coming weeks. So first one at the top there, review your results schedule. So I think Barry indicated this, reviewing your schedule is really important. Please have a look at it, make sure that your employer data shown on the schedule looks okay, that the numbers look like the kind of what you'd expect. Have a look at it and understand the impact of that contribution rate change, if there is a change. Have a look at what the impact that might have on your budgets going forward. And obviously highlight any queries you have, or if you spot any discrepancies, please let us know as soon as you can. And I think, as we said a few moments ago, there can be changes made to that draft schedule that you've got if there's reason for change. So if there is something wrong out there, let us know and we can go through the process of getting a revised schedule out to you. Having a look at that schedule and understanding it really gives you time to plan for your contributions for the next coming 3 years before that new rate takes effect in April. So the draft funding strategy statement consultation. So as Barry said, your results have been based on our draft funding strategy statement, which is about to open for consultation with you all. Also, other stakeholders are able to respond to the consultation. I think Barry called it the funding rulebook, and I think that's a really good way of describing it. But the funding strategy statement, it sets out the methodology of how funding levels and contribution rates are determined, as Barry's just been explaining, how we manage funding risks and maintain long-term sustainability for the fund. Consultation, it gives everybody the chance to have a look through that draft version of the funding strategy statement. Contribute your thoughts, please, and give feedback on the statement if you're able to over the next few weeks before we're at a point where we've got to finalise it. So finalising that statement, after considering your consultation responses, we'll make any adjustments necessary and finalise the funding strategy statement. This document then becomes the formal policy for the guide as to how the fund achieves its long-term funding objectives and manages contributions. The certification of employer contribution rates. So Barry, as the fund's actuary, will then formally certify your employer contribution rates for the next 3 years in a document called the Rates and Adjustments Certificate, which will be published on the Pension Fund's website. And this formal certification ensures compliance with LGPS regulations and confirms the rates that you'll be applying from April for over the next 3 years. And applying those contribution rates from April. So please ensure that your payroll systems are updated, or your payroll providers are notified to reflect the new contribution rates. I think, like I said a few moments ago in response to one of the questions, we'll be issuing new CR1 forms, those contributing reporting forms to you all before April, which will show your new contribution rate. So moving on. This is just a brief summary of the funding strategy statement consultation. So we've got a page on the fund's website which provides a brief summary of what the proposed changes are in this latest draft version. We issued an email out to all employers a couple of days ago on the 9th of December, and there was a link in that to that page, and also where you can get a draft version of the statement. Please do review it and respond with any thoughts or comments you have. It's maybe not up there with the Christmas Radio Times in terms of entertainment, but it is a key pension fund document. So your engagement with it as employees, it is really valuable. The consultation will be open immediately following this forum. And it's going to run through until the 1st of February. So if you've got any comments that you'd like to make, having had a look at it, you've got a whole month after Christmas to get those comments into us, and then we'll have a look at everybody's comments and take it from there. So all responses that you submit will be reviewed by the County Council's Pensions and Investments Committee, who are the pension fund's administering authority, and that process will happen in early March, and they'll undertake a final review of the statement, after which a final version will be published, and of course we'll let you all know when that's available. Moving on. And most importantly, please make sure that you apply your new contribution rate from the 1st of April next year. Like I say again, I'll just reiterate, we'll be issuing those new CR1 forms which will show your new rate in good time before the 1st of April, so you'll have those to confirm your new rate. And then this next slide really kind of shows how time moves fast. The next valuation, 2028, 31st of March 2028. And those rates are going to confirm, so that valuation will confirm the new rates for the period from 2029 to 2032, which seems an absolute age away, but it will come round very, very quickly. And just a final slide here, please keep us up to date with changes. Now, we know that it's very likely that for some of our employers, proposals for local government reorganisation might bring about some significant change, probably during the 3-year cycle the contribution rates apply for. So please keep in touch with us of any impending changes, or for admission bodies, changes to contract terms or periods, that sort of thing. That's just a really brief run through of the next steps. One thing that isn't included on the slides is that we are going to be contacting everybody next week to let you know about the possibility of a meeting with the fund and Barry or one of his actuary colleagues if you've got any questions about your new contribution rate. Now, the meetings will be set over 2 days in mid-January. I think we've got aside the 15th and 16th of January, with slots of about 20 minutes per meeting. The slots are very limited, as Barry and his team are also providing actuary services for numerous other LGPS funds up and down the country, as well as Derbyshire. So he's in high demand. So if you're interested in having a separate chat with an actuary in the fund, please look out for that email, which, like I say, we'll be sending over the next week. I think we're just, if you're still there, Barry, I think we've got another question. I'll just see what this one is. Oh, I can't see a new question. I thought we'd got a new one there. No, I don't think we have. Sorry, I must have misread that. Oh, hang on a minute. What's this one? Yeah, okay. Yeah. Somebody said this might be a stupid question, but can you tell us what the employee contributions will be? This is what we all really want to know. Well, as we've been saying, we've been issuing schedules to a number of employees over the last few days. We've still got a number of employers to finalise those schedules, and like I say, Barry and his team are working on those remaining cases. So we hope that all employees will have their schedules out at most by the end of next week. There might be one or two stragglers that take a little bit longer, but you'll certainly all have your employer results very, very soon. And if you don't have anything, let's say you don't have anything by the turn of the year, please get in touch with us and we'll give you an update on the position with your rate. And I think we've probably come to a point where we can just have a short 5-minute break to go and get a cup of tea or coffee. So if you're still there, Barry, I'd just like to say thank you so much for giving us your time this morning. It was a really, really useful presentation that you gave us about how it all works. And yeah, thank you. And
very welcome.
Hopefully everybody has gained something from it. So we'll have a break now. We'll have just a 5-minute break. So we'll be back, let's say, just after 5 past, maybe something like somewhere between 5 and 10 past 11. And then we'll move on to the remaining sessions where Dawn is going to give us an update on the government's LGPS Fit for the Future proposals, and Vinny is going to go through some other changes and emerging developments in the LGPS. So see you all in 5 minutes. I hope everybody's been able to get a cup of tea or coffee or whatever you freshens you up. And thank you for all coming back. And we've just had one more question while we're on a break, and I'll just cover this off. And it's not particularly about the valuation specifically. It's from one of our relatively new employers asking about if there are any plans to share iConnect data with them. Now, for new employees, it does take a little bit of time for the iConnect system to kind of get moving, and we will be in touch if we haven't been in touch with you very soon about that. And in fact, we'll respond directly to you after this session. iConnect is, of course, the platform that we ask all employees to use for submitting data to us on a monthly basis. So, moving on. The next session, we've got a couple of short presentations. One by Dawn Kinley, our Head of Pension Fund. And Dawn's going to give us an update on the Fit for the Future, the LGPS Fit for the Future proposals, which, like I said at the start, were kind of initially kicked off when the Chancellor made her speech, the Mansion House speech, about a year ago, opening a bit of a debate about the future of the LGPS, particularly in terms of how it's going to be funded in terms of investments. So, if you're okay to pick up, Dawn, shall I hand over to you?
Yeah, that's fine. Can I have the first slide, please, Vinny? Thank you very much. Good morning, everybody, and thank you very much for staying with us after the main event. Thanks very much, Barry, for that, and for Steve. So I wanted to update you all on the government's Fit for the Future proposals, which cover LGPS investments and governance. And I'll start with a bit of a recap on investment pooling. So we formed the LGPS Central Pool in 2017 with 7 other Midlands-based pension funds, and we subsequently built LGPS Central Limited as a company to manage investments on behalf of the 8 funds within that pool. And this was all in line with government expectations. It was a significant change for Derbyshire because up until that time, we were one of only a handful of funds that managed all our investments internally, so a very big change for us. By the end of November 25, we had transitioned almost 60% of our assets to either to the management or the oversight of LGPS Central. Okay, thanks, Vinny. So as part of the next stage of pooling, the government has confirmed that LGPS funds will have to delegate the implementation of strategy to their pool. So we'll be able to say how much we want in equities, for example, but we won't be able to say in which equities, and we won't be able to say whether we want it managed passively or actively. That will be a decision for the pool. We'll also be required to take principal advice on our strategic asset allocation from the pool, and the strategic asset allocation determines how much we have in the different asset classes. So how much in bonds, how much in equities, how much in private equity, infrastructure, etc. Pooling companies will be required to be FCA regulated companies, which fortunately our pooling company is. And we'll need to transfer the management of all our legacy assets. So that's everything that we haven't already transitioned to the pool. And we'll need to do that before the 1st of April 26. The pool will also need to develop the capability to carry out due diligence on and to manage local investments. And that's a very big push from the government as part of these proposals. These requirements will be introduced in the new pension schemes bill, which is currently going through the parliamentary process, and I understand it's currently at the 2nd reading in the House of Lords. We've sort of asked for a timescale of what that might be, but it's really hard to predict because it depends how many sort of questions it gets and how many amendments are proposed. Okay, thanks, Vinny. So in terms of pool governance, the government is going to require pools to publish their investment performance, and that's a very positive development. Currently, some do and some don't. And you would expect an investment management company to publish its performance. So that's good that will be required. They're not going to require a specific governance model for the pools. Rather, each pool can develop its own governance model. Obviously, since we've been going since 2017, we already have quite an established governance model, but we are currently reviewing that to ensure it's appropriate for the new pooling environment. And that process is being supported by a report from PwC and by external legal advice. So that's been going on for a few months and is still to be concluded. Thanks, Vinny. So as part of the Fit for the Future proposals, the government determined that only 6 out of the 8 pools would be able to continue. Fortunately, our pool was one of those, but this did mean that 21 funds from the Access and Brunel pools, which weren't given the go-ahead to continue, they all had to find new homes. So it's all been quite stressful for them, as you might imagine. 6 of those 21 funds have signed a memorandum of understanding with our pool, and this will take us to a pool of around 100 billion of assets, covering nearly 5,000 employers and 1.6 million scheme members. So it's going to be a fairly sizable undertaking. The Isle of Wight has also expressed an interest in joining the central pool, but that's currently still working through its own governance process. Thanks, Vinny. So this sets out the expected pooling landscape, with central likely to be the second biggest pool once the current round of consolidation is over. Hopefully this will provide a level of protection for our pool in any future consolidation exercise. The government has said they don't anticipate any further consolidation, but it's widely considered likely that the number of pools will reduce further at some point in the future. And particularly given it was considered when all this started that the Treasury really just wanted one pool. So we expect further rounds to come in the future, but hopefully not for some time. And I'd say hopefully our pool would be in a fairly strong position given its size. Thanks, Vinny. So there are some new requirements in terms of fund governance, although some of these requirements have already been best practice for some time. Funds will be required to prepare and publish governance, training and administration strategies and have a conflicts of interest policy. Fortunately, we already have all of those, but we will review them in the context of the new guidance. Funds will also need to appoint a senior LGPS officer, participate in an independent governance review every 3 years, and appoint an independent advisor to committee. Pension committee members will be required to have appropriate knowledge and training, and this is an extension of the current requirements for members of pension boards. So fortunately, we've always applied our training standards to committee members as well as to members of the pension board. But again, we're going to check that our current practice is appropriate in the context of the new guidance. Thanks, Benny. So MHCLG has recently opened up 2 consultations related to Fit for the Future, one on 2 new sets of regulations to implement the Fit for the Future proposals, and the other which is solely seeking views from administering authorities of LGPS funds on draft-related guidance. We are planning to respond to both of those consultations, although at this stage it really is just about the implementation details. There's no possibility of influencing the fundamental principles that form the proposals. We've already had those consultations and we didn't really get anywhere in trying to influence the proposals. Nearly every, in fact, I think every LGPS fund responded to them, but the government was pretty set in what it wanted. So that's been a fairly swift run through what is really some very fundamental changes to the way we manage our investments into some of our governance. We'll aim to keep you updated on progress on this, either via our website or via the employer newsletters. But if anybody has any questions on any of this, please do shout now or come back to us afterwards.
So no questions come through at the moment, Dawn. So if anybody's got any that they'd still like to ask about that. Just from an employer's perspective, Dawn, if I could ask one very, very quickly.
Yeah, sure.
The impact or the direct impact on employers, am I right in saying that the success or otherwise of how the extended pools operate and with their new responsibilities of if you like taking over the responsibility for investing, that will impact an employer's potentially down the line, won't it, in terms of feeding through to contribution rates, be it positively or negatively?
Absolutely, because I mean, currently we get the contributions in and we invest them to generate returns, capital and income returns, and those returns support the payment of benefits. So if those returns are less than they might have been, it would have an impact. But at this stage, the jury's still out. It's much too early. Pooling made a lot of sense from the point of view of you get economies of scale. Currently, 86 LGPS funds are all managing their investments, sort of responsible for managing their investments. Not many did them internally, but deciding, which managers they should use separately. So in theory, it makes a lot of sense, to pool that management and to get those economies of scale. But as I say, the jury is still out on whether the pooling companies will deliver performance. It's going to be quite difficult to measure them, because if you're sort of saying, well, if they sort of say we'll generate superior performance, superior to what? Superior to what the funds might have generated themselves, but it's going to be very hard to say what that would have been. I mean, obviously we can measure how they do against any performance benchmarks, but it's going to be nigh on impossible to measure what they're going to provide against what the funds would have been able to provide. But
so
yeah, it's going to be a long-term impact. There's no short-term impact on the employers. And the time for employers to be able to respond to the consultation on the very principled matters of these proposals has passed. This is really the very detailed implementation stuff here. So it's have they dotted the I's and crossed the T's on the regs, and is there anything in the guidance that will cause difficulties to the funds to implement and the pools to implement? So it's really more at that level now, and the turnaround times are pretty quick.
So from an employer's perspective, short term, no immediate impact, but long term, just keep your eye on it, and
absolutely,
just keep a lookout as to what's happening. And obviously,
definitely.
like Dawn said, we'll certainly keep everybody informed as things develop. I think we've just got somebody indicate they've lost sound. Hopefully we've been able to resolve that. So if anybody else has lost any functionality, please let us know. Thanks for that, Dawn. That's really helpful and a really useful update. Now we're going to move on, final presentation, to Vincent Kinder. We all call him Vinny. Probably, like I say, a lot of you might already have had dealings with Vinny as our lead on employee relations, and he's going to go through some of the kind of current and emerging matters that are kind of impacting on the LGPS. So over to you, Vinny.
Thanks very much, Steve, for the introduction. So good morning, everyone. In case you don't know me, my name is Vinny and I'm the Senior Pensions Officer working in the Employee Relations team. So today I'm going to cover some of the upcoming changes affecting the LGPS and also various consultations. So these changes are likely to affect you as employers and of course your employees that are in the LGPS. I apologise if you've already got a bit fed up of hearing about consultations, but there's a lot going on at the moment with many changes proposed over the coming months and years. So the first one I'm going to cover, so earlier this year in the summer, a government consultation called Access and Fairness proposed various changes to the LGPS regulations. The consultation closed on the 7th of August and, as its name suggests, focused on equal access to the scheme and its benefits. Nationally, the LGPS provides security in older age for millions of members, and the consultation focused on equal access to the scheme and its benefits. The proposals contained in the consultation cover survivor pensions, changes with regards to death grants, gender pension gap, opt-outs, forfeiture, and other miscellaneous changes, and I'll cover these in a bit more detail on the next slide. The government is currently considering the responses as a result of the consultation, and we expect changes to the regulations next year. So this slide covers some of the headline proposals that the consultation focused on. The first and most significant change is the equalisation of survivor pensions, as the regulations have treated widows and widowers different over the years. Undertaking this project will involve quite a substantial amount of work for administering authorities, finding out these cases that are affected and retrospectively calculating survivor pensions back to 2005, and then of course ensuring that we calculate new death cases correctly moving forwards. There are also various little changes suggested to address the gender pensions gap. Whilst the pay gap is the main reason for this, as an LGPS pension is based on pay, the changes proposed, such as addressing absences, becoming pensionable as default, and when going on child-related leave, the full year will be pensionable despite receiving no pay for the final 3 months. So this will involve changing the way that APP is applied for certain absences from how it's currently done at employers. So the fund will be responsible for reporting numbers of opt-outs and reason for opting out, which will rely on employers for providing some information, which will be required to go in the fund's annual report. Various changes in relation to forfeiture. So if a member is convicted of a relevant offence and there's a loss of confidence in the public service or reputational damage at stake, then an employer may wish to forfeit some of the person's accrued LGPS pension. The subtle but important change that was proposed removes the requirement that the member must have left employment because of that offence and remove the 3-month time limit to make a forfeiture application. So in terms of the Access and Fairness consultation, the Pension Fund issued a response to this consultation, and a copy is available on our website if anyone wants to have a look at that. Moving on to inheritance tax. So in the 2024 budget, which is some time ago now, the Chancellor announced that from 6th of April 2027, most unused pension funds and death benefits will be included in the value of a person's estate for inheritance tax purposes. So under current rules, unused pension funds and death grants are not liable for inheritance tax, where the trustees or scheme managers have discretion in deciding who will receive them. The LGPS is one of those. Currently. So from 6th of April 2027, the proposed changes would mean that LGPS death grants will be subject to inheritance tax from April 2027. However, HMRC have since confirmed that it'll only be inheritance tax will only be paid on death of a deferred member or pensioner member, and death in service lump sum payments will remain excluded. Personal representatives will be responsible for calculating whether any inheritance tax is due and pass on the relevant information to the administering authority. Administering authorities will be responsible for paying and reporting to HMRC any inheritance tax deducted from an LGPS death grant. So for the pension fund, this is likely to mean a bit of additional complication when paying death benefits and communicating with next of kins and executors to confirm a person's inheritance tax situation. So we'll have to get things in place for when that legislation goes in. So moving on to another consultation with actually a very similar name to the one earlier in the summer. So this one's called the Access and Protections. It's open right now, and this one focuses on proposals to change the regulations in 4 main areas as shown on the slide. So I'll briefly just summarise each of the 4 areas, starting with the change to the normal minimum pension age. So the normal minimum pension age is the earliest age from which pension scheme members in the UK can take benefits from their scheme, apart from unplanned circumstances such as ill health retirement. So currently, the normal minimum pension age is 55, but the government has announced that it will rise to 57, effective from 6th of April 2028. So this change was included in the Finance Act 2022. And this rise in normal minimum pension age will apply to all registered pension schemes in the UK. The consultation sets out how it will be applied to the LGPS in England and Wales and the related protections. So to cater for the increase in the normal minimum pension age, the Finance Act introduced measures for a protected pension age for scheme members who were in their pension scheme before 4th of November 2021. And the consultation includes measures to introduce that protection into the LGPS. So subject to the proposal being implemented, those protected members will still be able to take their pension from LGPS from age 55. So the second proposal in the consultation relates to the eligibility for LGPS membership for councillors and mayors. So eligibility for LGPS was removed for councillors in England when the new scheme regulations were introduced in 2014. The proposal in the consultation is to restore relevant elected councillors' eligibility for LGPS membership and extend it to mayors and deputy mayors of combined authorities. So the intention is that elected members who decide to join the scheme will participate as members in the 2014 arrangement, and as far as possible, that elected members should be treated in the same way as other scheme members, but with a few subtle differences. The third proposal in the consultation covers the government's proposal to change the rules around consolidation of academies operated by a multi-academy trust into a single LGPS fund. Over half of schools in England have converted to academy status. Most academies now part of multiple academy trusts. These trusts often operate schools across different geographical areas, meaning their staff eligible to join the LGPS may participate in multiple local funds, each administered by its own authority. The LGPS regulations currently specify that the administering authority for an academy is determined by the academy's location, not where the MAT's headquarters is situated. So the main proposal is to simplify the process for MATs to consolidate their academies into a single LGPS fund, with the intention to remove the administrative complexities for MATs when the academy operate across multiple pension funds. And finally, the fourth proposal in the consultation relates to introducing the new fair deal, which provides protection for outsourced workers into the LGPS. To give a bit of background, fair deal was first introduced in 1999 in government guidance, setting out how pensions issues should be dealt with when central government controlled public sector staff were compulsorily transferred out of the public sector to contracted service providers. Under the guidance, staff should be given continued access to either the existing public service pension scheme or to a pension scheme certified as broadly comparable to the scheme they were in before the transfer. The fair deal guidance was followed. In 2007 by directions extending the same protection to local government workers. In 2013, the government strengthened its central government policy by publishing new fair deal guidance, which removed the broadly comparable option, meaning that there wasn't an alternative to maintaining the public service pension scheme that the transferred members were in. The proposal for introducing new fair deal into the LGPS centres around bringing in a deemed employer status, where the contractor does not become a full scheme employer in the LGPS. Instead, the outsourcing body remains the LGPS employer for outsourced staff, known as the deemed employer. The proposal covers a number of detailed provisions to set out how pension-related responsibilities are split between the contractor that staff have been transferred to and the deemed employer. Sorry if that was quite detailed, but that consultation is currently open until 22nd of December 2025. And the preferred method of response is to complete MHCLG's online survey. We've already circulated details of the consultation to all employers and requested that you share it with your LGPS members as well. So hopefully you've all done that. And just to confirm, the fund will be responding to the consultation as well. So moving on to pension dashboards. So you may or may not have heard of pension dashboards. We recently did a short article in the November employer newsletter about dashboards, but in case you missed it, pension dashboards are a national initiative to let individuals safely view all of their unpaid pension benefits, including their state pension, in one place. So this should help locate any pension accounts that individuals may have lost and help them plan for retirement. So all pension providers must connect to the dashboards by 31st of October 2026. We, Derbyshire Pension Fund, have successfully connected to the dashboard by our deadline, which was 31st of October 2025. So that was the deadline for pension schemes in the public sector. And when the dashboards become available to the public, individuals will need to use the government's gov.uk one login to securely prove their identity as part of the registration process. So if you're interested in dashboards, more information can be found on their website shown on the slide. We'll certainly be in touch with you whenever there are further updates on the programme, as we'll be reliant on accurate and timely data from employers in order to submit information to the dashboard so that people can see their information. Okay, we're pleased to know this is my final slide and it's not related to a consultation. The fund's online platform for members called My Pension Online is getting an upgrade, and that should be in January. The new platform has increased security through multi-factor authentication. So you may already experience this for other platforms such as online banking, and when you log in, you'll be sent a passcode via email or text to verify it's you. Registration will be easier as there'll be functionality to be able to sign up and register in one go by using electronic ID verification. This is opposed to the current method where you have to complete an access form and sort of waiting for 5 days for a link to register. So everyone's registration details that are registered for My Pension Online will automatically transfer to the updated platform, but you'll use your email address as your username. But further details will be sent out to everyone once the upgraded platform goes live. It's more user-friendly in terms of navigation, and it has additional features built into it, such as a lifestyle planner and other functionality, which the fund will look at using to smooth out processes for scheme members. We'll be in touch with you as well with further updates on the upgrade as and when necessary. So that's all from me. We've reached the end of the slide, so unless there's any other questions from the Q&A, I'll hand back over to Steve to close the session.
Yeah, no, thanks, Vinny. That's really helpful. There's a lot going on in the LGPS at the moment, and you can tell that the number of consultations that we've referred to, that Dawn referred to and Vinny's referred to, and we're opening our own consultation today. So there really is a lot changing, and a lot will continue to change, I think, over the coming months. Just picking up the point that Vinny was mentioning there about the new platform for My Pension Online, I think it's probably worth mentioning that if any employees out there have a direct link on maybe their intranet site to the homepage of the My Pension Online platform, that's something that when we get to the point of flipping over to the new version, you'll have to change that. So, but we'll be in touch. But something to look out for if you do have a direct link to the My Pension Online platform on your own site. So I think we've pretty much come to the end. Like Vinny said, no more questions have come through. Thank you so much for sticking with us over the last, an hour and 3/4 nearly. We've gone through a lot. Barry's gone through the actuarial valuation with us, why it happens, how it happens, what it means. That was a really useful insight into it all. Obviously, the FSS consultation, I can now declare, is now open. So you can go on to either go to the link on the email that I sent, or I could very quickly actually show you a quick way of finding it. If you just bear with me for 2 seconds. Hopefully everybody can see that. And that is our pension fund homepage. So if you go to the homepage and just scroll down the screen, if you're on a desktop PC, or you can do it also in any other way through a mobile or a tablet, go down to the bottom, and our latest news item is always there at the bottom on the left hand side. So if you just click on that, that will take you to our consultation page, where there's some details about it, a brief summary of the proposed changes, and there's a button there called respond to the consultation. And right at the bottom, there's a link to the draft funding strategy statement. So that's our consultation, which literally has now just opened. So when you've had a look through it, when you've gone to the document, had a read through, considered whether or not you think you'd like to make any comments, that's how to respond. Click on that button on the news item and send through your comments to us. And like we said, you've got until the 11:59 p.m. on the 1st of February to get your comments in to us. So, like I say, thank you so much for sticking with us for the last hour and 45 minutes. The next thing you'll get from us is, for those who haven't received their schedules, we'll still be continuing to send those out in the coming days. And we'll also, like I said earlier, be sending an email most likely next week to let you all know about the slots becoming available to have an individual chat with Barry and one of his colleagues and somebody from the fund about your own LGPS contribution rate if you have any queries or concerns or questions about it. So please look out for that. And all it's left for me to do is thanking Barry and Dawn and Vinny for presenting, and the colleagues behind the scenes for helping this happen, and particularly yourselves for joining us today. So thank you very much and hope you enjoy the rest of your day. Thank you. Bye-bye.